Hey guys, what's going on? Welcome to the YouTube video. Hope you guys are doing well today. So today is going to be a little bit of a catch-up video with you guys, all right? So let's get to it. I want to talk to you about range bars, which is my newest discovery, and really it's a great discovery because range bars are blowing my mind right now as to the amount of clarity you can get on a chart as opposed to traditional time-based candle bars. You guys know I look at order flow here. Range bars is just a way of smoothing out the data on your chart. All right guys, so if you're new here, don't forget to hit the like button and subscribe to the YouTube channel. We've got plenty of other tutorials on trading and certain trading platforms. So let's get to it right now. So what you're looking at here on the right side of the screen is a chart for NASDAQ futures 19 range chart. So when the market moves up or down by 19 ticks, it creates a new bar. So as you can see here, the market's accelerating to the downside pretty quickly, and these bars are forming quicker. It's an interesting thing because when the market is not moving in price, the range bars will not form. So essentially, it'll keep you out of noisy, choppy markets. So let's just do a basic comparison here, and we'll look at these range charts versus a traditional time bar, and you'll know exactly what I mean. And then I'll also show you another example on a lower float penny stock, for example, and you'll really see how some of these range bars can shine. Let's get to it here. So look at a 2-minute chart for NASDAQ. Starting from the open of the market, we had a rally, and then we had the chop starting around 10 o'clock. So just get an idea for how this looks currently, and then I'm going to switch it to the 19 tick range bar and then take a look. All right, so let's go back to the open of the market, and you can see that it looks, in a way, a lot smoother. Upward moving market, and these bars are forming based on the movement of the price. It's not based on the amount of time it took for a price to move. And again, time is another factor that can be used in analysis and market profile. But when you're looking at short-term price action, it doesn't matter what time it is when you're looking at live markets. It's a matter of if there's opportunity or not. Looking at these range bars, you can see how clearly they form and how clearly they smooth out the data. I'm happy that Tradingview has range bars for that reason. Very cool. Starting from about 10 o'clock, you would have seen it very clearly that the market was starting to chop around this area. We take out the low, chop, we take out the high, chop, and then we take out the low, chop, then we take out the high again. So this is when you got to start pumping the brakes generally, and you can kind of see that when the volume starts to drop off. All right, guys, let's look at another example here on a Canadian penny stock trading on the Canadian Securities Exchange. So look at this chart right here. Let's look at a 2-minute chart for today's action, or for the last 2 days action. And you can see, because this is a thinly traded stock, it looks like hell on this chart, right? If I switch it to a range chart, let's say 3R, which means that for every 3 cents the stock moves, it's going to create a bar. You can see how it does a good job of smoothing out the data. Now, what's really interesting is if we zoom out here, all right? So if you look at this right here, look at how during this time the stock was essentially asleep. So this was over the time period of many months. And when you smooth out the data, actually it doesn't look so bad. But if I look at this on, say, a 30-minute chart, it just looks like absolute hell, right? You can't really see what's going on. You can see that there was a lot of volume there, probably insider trading. However, it really looks like a big mess. Check out range bars in your trading. They might be of use to you, especially trading on stocks that move on a thin amount of volume, and also to smooth out choppy market conditions. So the next thing I put on the chart here that I want to talk to you about is this thing. So what this is, it's a public script that someone put on Tradingview, and it's called wick delta buy and sell pressure. It's actually similar to an indicator known as zigzag, and I'm going to try and find that for you right now. This is an example of a 2-minute chart, and you can see when the market has made swing highs and swing lows, it puts in the volume and the delta on the swing high and swing low. The cumulative delta is basically the sum of volume traded on the ask and volume traded on the bid. Basically, it means if the number is positive, it means there were more buyers than sellers. If the number is negative, it means there were more sellers than buyers. Now, in some cases, looking at these delta divergences can give you insight about how strong or weak certain participants of the market are acting. In this case, you can see we had a 143, and then we had a 46, and then we chopped, and then we traded lower. Really, this is just a nuance, right? So you don't trade off of cumulative delta, but you use it as a nuance. And I'll show you an example from last Friday that was a great one. Okay, so this would have been the open of the market last Friday, and I wanted to focus in on one specific moment of price action, which would have been right around here. Look at the cumulative delta during this moment right here. So if you were short at this moment, you were looking for the sellers to take control under this 12,485 general area. But if you were watching this, you would have noticed that the sellers were very dry every time we traded down there. But really, there was no supply hitting into that point, right? And you saw that if you looked at cumulative delta. delta right here. So look at how this market consolidated, and before we shot up, look at how the sellers were just drying up slowly, right? So the sellers were in control here, and then when we started to consolidate, you saw essentially the lack of selling that essentially contributed to the idea we would probably trade back higher at that point. And again, it's all subjective, but it's just a nuance. That's the point of looking at it. So I went through all of the other cumulative delta scripts on Tradingview. This is the best one I found that looked clearest to me, but there are others as well. Yeah, so if you want to see what that one looks like, you go into public library in Tradingview indicators and strategies, and you just go to wick delta buy and sell pressure. This guy made it. Scarf. Congratulations, sir. Epic indicator. Alright guys, last thing I wanted to tell you about is the standard deviation channels. In case you don't know about these things, they're very useful to stay out of trading noisy markets. Alright, so in this case I have the 19 tick range bar, and these things I have two of them, one for 80 and one for 20 bars. So in this case the 80 bar is actually pretty good reference. So you got 80 bars of price ranges, and in this case these standard deviations are set to 2 standard deviations away from the mean. So the mean of prices starting from this point to that point slowly decreased. Therefore, we have a downward sloping line. So what these lines are essentially is, in this case, 2 standard deviations above the mean and 2 standard deviations below the mean over the span of 80 bars. You don't trade based off of that. You use it as a way to gauge price movements. So according to theory about standard deviation, so one standard deviation encompasses 68% of all price moves, and 2 standard deviations is encompassing 95% of all of the price occurrences based on regression to the mean. Another good thing about these linear regression lines is essentially the standard deviations are calculated based on how much the market is moving over the period of a certain amount of time. It generally gives you a good idea of the volatility, right? If the market all of a sudden moves drastically, the linear regression lines will adjust their positioning. That's what they do essentially. They're made to calculate the mean and 2 standard deviations away from the mean over the span of the amount of bars you select. The way it works on Tradingview is that it calculates the most recent action for you, but actually if you go right up here to the top left, click on the trend line and then go all the way down to regression trend, you can actually use this for any specified time period you want. So let's say I go from the market open, click there, and then I want to measure the mean and the standard deviations all the way until right now. I'll just drag that line there, and now we can see this is the approximate linear regression for the entire session so far. So in this case, the mean of prices would have been somewhere in the middle here, and this would be 2 standard deviations down, 2 standard deviations up. And again, guys, just a good way to see certain inflection points and potentially stay out of trouble. So on Tradingview, this indicator is called linear regression. All right, guys, that's gonna be it for today. I just wanted to show you range bars and the kind of stuff that I'm looking at on these charts right now. I'm actually not live trading for the rest of the year, so I'll be back live trading in January 2021. I'm taking the next 3 weeks to just focus on YouTube and clear up my mental state. So guys, I wish you a great one, and I'll see you in the next video. Take care, bye.